Everyone is watching Bitcoin right now, but the next move might be decided by something completely different. And if you're not paying attention to this, you might be missing a big part of the picture. April just came to an end and Bitcoin did exactly what we have been talking about. It rallied into the bear market resistance band before starting to slow down. Rolling over into May is something we have been discussing for a while on this channel. And now with the Feds keeping rates unchanged, once again no rate cuts, we are moving into a really important period for risk assets. But here's the thing, if you're only watching crypto right now, you're probably missing what actually matters. So in this video, I want to zoom out. We are going to be looking at oil and the S&P 500 and how these two things can affect Bitcoin going forward. Because the real signal might not be coming from crypto at all. Now, let's start with something that has been moving a lot recently. Energy stocks. More specifically, oil on the weekly time frame. This is where things start to get interesting. Because something is happening here that most people in crypto aren't really paying attention to. Oil has been pushing up aggressively, mainly driven by geopolitical tensions, especially around Iran. That part is obvious, but what's not obvious is what happened right after. Right when oil started slowing down, Bitcoin began moving up. That's not random. There is a relationship here that actually matters. When oil goes up, markets tend to shift risk off. When oil goes down, markets shift back toward risk on. And the reason is simple. Higher oil prices mean more inflation pressure. That leads to tighter financial conditions, less liquidity and more uncertainty. And all of that is bad for assets like Bitcoin. On the other hand, when oil starts to go down, that pressure eases. Liquidity improves, conditions loosen, and risk assets in general tend to perform better. So what we are seeing right now is almost an inverse relationship between Bitcoin and oil. And this is important because the next move for oil could directly impact the next move for Bitcoin. So let's talk about the levels that actually matters, because this is where it becomes actionable. $100 on oil is a key level. If oil breaks above $100, then we are likely looking at stronger risk-off conditions, more pressure on the markets, and that would not be great for crypto in the short term. But if oil gets rejected from here, for example, if tensions ease or momentum fades, then the more likely move is a pullback toward the $65 to $70 range. And that matters a lot, because it was the breakout area. A move back into that zone would be a healthy retest, and in many ways it would actually support a more bullish environment for crypto and Bitcoin. So right now there are really two paths. Either oil continues pushing higher from here, which would increase pressure on risk assets, or we see a rejection, a move back into $65 to $70 range, maybe a short-term bounce, and then potentially continuation lower over time, even toward the $40 to $50 range. And if the second scenario plays out, it delays any major inflation spikes from energy, and that supports risk assets overall. So if you are trading Bitcoin right now, you should be watching oil, because this might be one of the key signals that the market is quietly reacting to. And you can actually see this relationship visually when you compare Bitcoin to oil. Now the concept here is simple. When the chart moves higher, Bitcoin is outperforming oil. When it moves lower, oil is outperforming Bitcoin. And recently something important happened. The previous trend broke, which was the signal that oil started outperforming Bitcoin in the first place. But now we are starting to see signs that momentum might be shifting again, almost like a small divergence forming. And this is where it gets interesting, because if that shift continues, it could be an early sign that the relationship is flipping back. And if that happens, that's usually when Bitcoin tends to do better. And just to address something quickly, this analysis is based on US oil. Some people prefer Brent since it is global, but structurally it doesn't really change. The behavior, the levels and the overall structure is more or less the same. So whether you're looking at US oil or Brent, the bigger picture stays the same. Now let's shift over to the S&P 500, because this is where things gets a bit more serious. The market has been rallying and so far it hasn't really shown strong signs of slowing down. Earlier I talked about the resistance band and how ideally we would see rejection there. And it just rallied straight through it without showing any signs of slowing down. And that's important because there is a bigger pattern forming here. This is something Benjamin Cohen has talked about before, looking at the S&P 500 relative to global liquidity. If you go back to the .com bubble and compare that structure to where we are today, it's surprisingly similar and honestly a bit concerning. So let's break this down into two scenarios. Let's start with the best case scenario. The S&P pulls back from here, we get some consolidation, and then the market continues higher in a healthier structure. That would be the ideal path. But the worst case scenario is this. We continue pushing higher like we are right now without a proper reset. And then later in the year, possibly around Q4, we see a sharper move to the downside. Now interestingly, that timing actually aligns with when many expect Bitcoin to form a more significant bottom. But here's the part people don't think about. After that drop, you could get a strong rally and then eventually roll over into a longer bear market, possibly lasting a couple of years. Now, am I saying that's guaranteed? No, but it's a scenario I'm definitely watching if the S&P continues to go higher. Because if the largest market begins to struggle, it's going to affect everything else, including crypto. So bringing it back to Bitcoin, we haven't seen a full breakdown yet, but we are starting to see early signs that things might be shifting. In my last video, I talked about the USDT dominance on the weekly time frame. It was holding support and starting to bounce. And typically when stablecoin dominance rise, that signals risk off in crypto. You can also combine USDT and USDC dominance and you'll see a very similar structure. So right now we got multiple signals lining up. Oil at a key level, the S&P 500 potentially following a concerning path, and stablecoin dominance starting to rise. None of these are confirmations on their own, but together they start to paint a picture. And it's one that's definitely worth paying attention to. So yeah, a bit of a different video today, zooming out a bit because sometimes the most important signals aren't coming from crypto at all. Now overall, I'm staying cautious right now, but in the short term, if some of these things start to shift, there could definitely be room for more upside. So if you got any value for this video, remember to like and subscribe. Comment down below what I can do better. I love to hear from you guys. And remember, in this market, patience beats hype and preparation always beats predictions. I'll see you guys in the next one. Peace.